There's a rather conventional piece of market wisdom, if you will, out there. Never short a dull tape. In other words, never bet against stocks when not much is happening. But could this rather quiet period for the market be an exception to that rule? Let's find out. Welcome to Trading Nation. I'm Brian Sullivan. Good to see you again. Max Wolff, Manhattan Venture Partners, and Stacey Gilbert with Susquehanna are your Trading Nation team today. Max, is this time the exception to that don't short the dull tape rule?
Yeah, so I think it might be in part because I think the tape might be a little less dull than we think geopolitically and for a bunch of other reasons and federal bank policy reasons. It's not that dull of a tape. We've seen low volume, but look, we saw a market overcorrect down, then overcorrect up. So even if it looks like the calm right now, that really smells like a storm in the air to me.
And what kind of a storm?
So I think the shares are a bit overbought here, and we're going to see more downward pressure. I think we've got a lot of negative news that wasn't forecast in because we got fixated on a few pieces of news out of China and maybe dollar policy and maybe energy policy. We overcorrected on that basis. We over-recovered on that basis. So I think what looks like calm air is actually kind of a little bit of a vacuum here is actually going to set up for a pretty good time to be short some of the recent high flyers that don't have any fundamental support to their bounce back.
Okay, so Stacey Gilbert, if Max is right, maybe there's a storm a-brewing. How do we protect ourselves using the options market?
Yeah, I would actually agree with a lot of Max's points here. In general, when the markets are calmer, when your VIX is below 15, the market does perform better over the next 6 months versus your higher volatility areas. But to Max's point, very rarely are we looking at a spot where we've rallied almost 12% from some of the lows. So ways that I think you can look for protection. Right now, you're 5% out of the money put. This is historically what most people will look to when they're looking for protection. This is on the SPX. It's trading around 175 basis points of the price of the SPX. It's still probably on the higher side. Even if Max is right and we do get a pullback here and maybe we're looking at a 10% pullback, it's going to take a while and it's going to take a lot for that to kick in. One of the strategies I continue to like for some of these shorter pullbacks here is the 2.5, 10% out of the money put spread in the SPX. I just think you're taking out, even though the volatility is low, if we drift higher, because it could also be that kind of a market, you're not spending as much money with it. And in terms of those 10% out of the money puts, the cost of those is actually high on a relative basis across history. So basically, the market is kind of pricing up that protection higher than it historically has. But that 2.5% put that you would own via that put spread, it's going to kick in sooner. You don't need as much of a pullback for you to get some protection here. So I continue to like that 2.5, 10% out of the money put spread in the SPX.
All right, 2.5, 10% out of the money put spread in the SPX. Can't be more clear than that. Stacey Gilbert, thank you very much. Max Wolff, worried about a storm. Thank you very much, both of you. Thank you for tuning into Trading Nation. I'm Brian Sullivan, and we'll see you right here next time. Take care.